Welcome back to Vantage. We've just had the UK budget and 3 takeovers this week, and I am delighted to get a guest on who's really focused on the UK. We're going to talk about the catalyst that might unlock the valuations and bring the UK back to a recovery mode. Let's go take a look. Welcome back to Vantage. Delighted to have Gervais Williams back on the show. Gervais, you're well known, but just for those who don't know you, just a quick overview of you, the funds you manage, etc., and then we'll get into the nitty gritty.
So I'm an experienced fund manager dedicated to UK, particularly emphasis in small caps. Mm-hmm. The Diverse Income Trust, of course, invests across in big and small companies. Big bias towards income and income growth. Yeah. Cash consumptive, cash generative growth is a very good way of making money long term. We're pretty excited by that, and particularly, we've been a period where small caps have come down a bit, and where we're looking at recovery potential.
Okay, and look, I mean, you have been for a while a sort of proponent of the opportunity in sort of UK small caps and mid caps. And increasingly, I'm seeing the sort of chorus of more fund managers, more people in the investment community join that. And so, you're not a lone voice. I mean, by all measures, the UK looks cheap, particularly against the US. And really what I wanted to sort of get into within this interview is actually the potential catalyst that might actually lead to that change rather than it just sort of continue to perpetuate. So let's start with something which is current, the budget. It sort of, we ran through it. Was there anything that stood out for you that's going to help the UK equity markets? Was there anything that excited you about it?
I think the nature of the budget this time was actually there wasn't any really significant changes. In a way, you might say, thank goodness, politicians, they can't stop themselves changing, right? So thank goodness, nothing kind of too crazy, but most particularly probably a missed opportunity, to be honest. Yes, we have got the dedicated ring-fence ISA for the UK, so effectively that is £5,000 which can go into UK equities. I think that will drive renewed interest, but it's out for consultation. We won't hear back till June where they are. They probably won't introduce it until perhaps maybe April 2025 onwards. It would have been lovely to have it sooner. There's just no urgency. We've just got to get on with it.
Yeah, I think that, the Edinburgh reforms have been on the table for a while, and it feels like, yes, we're still talking about it. Love to see the action, but I have seen a little pickup in interest just on the back of the ISA. So I happen to be talking to a Gen Z platform that sort of brings investors into the world of equities, and they've certainly seen a sort of pickup in interest. So there's hope there. When the UK market's been characterised by a spate of takeover, so one sign that it's cheap is that the peers of these companies or experienced professional investors are coming in and taking out some very good companies, and that is one way of seeing value unlocked. But we recently had Spirent Communications bought at circa 50% premium, but it did feel a little bit short-termist in my view. What's your view of in the case of Spirent or some of the others, are these premiums really reflecting the true long-term value of these businesses, or do you think that people are taking a sort of opportunistic stab at the UK companies?
Well, I think if you take Spirent, I mean, if you look back, the share price was higher than the current bid, a few years ago. If you look at some of the recent ones, maybe Virgin Money just came through yesterday. Of course, we've had another one, Matloli Wood today. So these are all companies where the share prices have been higher in recent years. And you just think, is that really the best we can do? So I'm quite disappointed with the takeovers. Clearly they are cheap. It is a good transaction as far as the board are concerned. It is cash back into the UK market, which can be recycled into other companies. So other companies perhaps will get the benefit of it. But basically, valuations are depressed. And most particularly small companies, which have been adversely affected by the ongoing redemptions of UK open-ended investment companies, that pattern of sellers which has been overhanging has had an effect on the main market, but there's international buyers that come in there. But when you get in the small companies, the AIM market, the AIM all-share index has underperformed the FTSE 100 since the end of 91 by something like 65%. These companies are extraordinarily cheap. It's nice to get an uplift, but it's a relatively disappointing outcome given where the ultimate upside may be.
Yeah. Now, I want to sort of explore, so I mean, the takeovers to me suggest the market is cheap. Really, what I want to do is sort of get into perhaps some of the triggers of what might change it and the catalysts. And I focused particularly on the fact that you like optionality in the businesses that you invest in, and this leads to, you know, if you get it right, it leads to substantial upside. But perhaps you could explain what you mean by optionality.
So I think the investment thesis is you pick companies, some of them do better, sometimes they get 50 or 70% in share price over 2 or 3 years. Terrific, wonderful stuff. If they've got an income, because the income grows, you get the cash to invest, you can buy more shares, you can get more upside as a result of that. All very good stuff. When I'm talking about optionality, really I'm talking about getting lucky. Sometimes a business isn't just successful, but then for whatever reason, the circumstances change in its favour, and it gets a really long run, and its share price doesn't go up 70%, it goes up 7-fold or something. That's what we call optionality. Now you can get that in big companies. Of course, we've seen Nvidia recently, which has had some optionality of its own. Now that's a mega cap, I understand that, but you find it more frequently amongst small companies, and particularly in UK small companies starting from very low valuations. When they get lucky, they can get very, very lucky, not only just in catch up in valuation, but of course on top of that, the upside optionality. So that's really what I mean by optionality.
Yeah, and it's this sort of combination of a better growth trajectory, more profitability, but also as they grow in market cap size, I guess they get onto the radar of more investors, and that leads to the sort of uplift in the underlying valuation multiple.
That's very true. I mean, obviously many of the companies in the UK are quoted are what's called microcaps. Now, microcaps seems like, you know, they're tiny companies, they're kind of corner shops or something. No. These are global companies. They might have, you know, millions of pounds profit. They might have hundreds or even thousands of employees. They're just very, very small compared with Nvidia or Shell or whatever it is, right? So these are global businesses, but they're deemed as microcaps because they're not big companies. But it still means they're successful businesses. They've still got great business models. They can get not just success, but they're more immature, so they can grow probably more their dividends at a fast rate. So all of these features, I think, are very overlooked at the moment. I think globalization has all been about bigness. You know, and bigness will carry on. We'll never get rid of bigness from our portfolios, but ultimately we need more smallness. That pattern change is coming. That's going to favour not just, you know, the UK stock market as people move away from capital growth, but into income. But most particularly small quoted companies, where we see the disproportionate upside potential.
Yeah. And I picked through your fact sheets, your holdings, etc. Now there's a few names that I want to explore because I think these perhaps give examples of that optionality or the catalyst for change. And the first one, which I sort of thought was interesting, was CyanConnode Holdings, which I think you do own. What does it do? And explore what excites you about this business?
So CyanConnode is a business which has been investing in India specifically. It's a UK company, but it's been investing in India, particularly in smart meters. Smart meters as a market is still very immature in the Indian market. It's developed into the number one supplier of smart meters, 25% market share. The really excitement is that President Modi has decided that everyone's going to have a smart meter, just like the UK really. And there's billions, 5+ billion to be invested in more smart meters for more Indian households. And of course, CyanConnode, being the number one supplier, is in a prime position to actually gather not just orders, but very substantial orders from here. Currently, their market cap is only about 35 million. They are tendering for £1.1 billion worth of business. Now, clearly, they're not going to get 1.1 billion. I think we can all work that out. If they get 25% of it, we'll get over the disappointment, right? If they get 10% of it, we'll get over the disappointment. So again, we are just on this period where it's moving into profitability, it's moving into substantial cash generation. Clearly that'll pay dividends in future. It's only a quarter point in terms of percentage of the fund, because it's an immature holding at this stage, it's not producing income. But you can find that these companies don't just succeed in terms of generating cash and paying dividends, but their share price uplift can be quite substantial, and that can deliver quite an attractive return for investors.
Okay. Another company which caught my eye, and I think, again, probably under most people's radar, given its market cap size, Ondo InsurTech. Quite an interesting business and some interesting contract wins. Again, maybe you can explain what they do and what's interesting about it for you.
So the nature of Ondo is actually, it's again a very immature company, only about 20 million market cap. But specifically, what it does is it's just something very simple. On your in pipe to your household, you just clip it on actually. And when you've got a leak in the household, of course, it carries on dripping through the night, and you find that there's some cold water comes into your house, sort of colder water than the rest of your household. So effectively, you get into a position where it can detect leaks during the night.
Yeah.
And so if you've got a leak in the loft or somewhere else, basically it picks it up. It's very early at picking it up. Now that's great, obviously, for picking up leaks, but it's really, really important for the insurance companies.
Yeah.
Because the insurance companies have to pay for the repair of the leak. If they can pick that earlier, then obviously there's less repair. It's good for the environment because obviously not just less water, but actually just less replacement of roof timbers or whatever else has been damaged in this. So coming back to it, they're just getting into insurance companies. So last year, people got pretty excited because they got one of the top 10 insurance companies in the US, nationwide, took it on, and they're going to give it free to their customers because it's worth it to them. So Ondo don't have to do much sales, they just have to provide these things. And then more recently, they've just done a deal with Southwest Water, for example. Yeah. Again, very interesting. It's a very immature company. It's actually held in the Microcap Trust. It's not held in a stage in diverse, but as it grows, as it produces cash, it could easily come into the diverse income portfolio in due course.
When I hear you speak about how you pick companies and you're looking for things around sort of great, that USP, great customer service, a high quality
Absolutely.
company, one which, when you look at the sort of ratings on external ratings where it looks interesting is XPS Pensions.
Absolutely.
What does it do? What is interesting about it? And perhaps you could touch in particular about, the customer service element of it.
Absolutely. So this is a company which came into the portfolio in the early part of 2021. So its share price has been fairly dull for a long period. It is actually a company which is helping insurance companies sort of manage their liabilities. This is a complicated area. There are some mainstream players. They like to outcompete the mainstream players by customer service. They've been taking customers. They won BT pension scheme maybe 3 or 4 years ago. That was a kind of, not just that they win BT pension scheme, but it's one of the top pension schemes in the country. So from that point of view, it really demonstrated that they were winning major customers. But most particularly, they like to not just excel, but they engage with their staff. They've got very, very high staff engagement. People love working there. They've got all sorts of metrics which show that. And when you've got a very dedicated and engaged workforce, of course, then you can deliver outstanding service. So I think the leadership's done a great job of delivering outstanding service. What we've seen recently, of course, is with LDI, liability-driven investments. They shocked people a couple of years ago with the Liz Truss budget. So from that point of view, there's an awful lot of work. They're working very hard. They've grown the business well. We've seen not just sales growth, not just profit growth, but actually a real step up in the final dividend. Last year, I think the final dividend grew by 18%.
Yeah.
In a way, it doesn't get more complicated than that.
Yeah.
That's all you need. Clearly, the share price has also been reflecting the exciting prospects.
Okay. Something slightly larger than other things in your portfolio, and again, it caught my eye, was TPIcap. Which a lot of your companies are much smaller than this. This is in the billions of market cap.
Yeah.
Why did you pick that, or how did that turn up on your radar effectively, and what attracted you to invest in that?
It's a well-established business. It's involved in trading bonds. So when you need to buy a bond and sell a bond, clearly you need a participant. So they're a well-established broker in that regard.
Yeah.
But what they've done is they've actually merged and they bought the LiquidNet business. And the LiquidNet is a sort of automated platform where if you've got a trade, particularly in equities, shares, you can buy and sell them. And they're very well integrated into most of the mainstream fund management groups across the world. Now, the reason I bring this up is actually, we complain about illiquidity in small companies or mainstream equities in the UK. When it comes to bonds, particularly because they have lots of different types of bonds, all with slightly different criteria, these tranches, as they've called, are all different, and they're much more illiquid than the equities we deal in.
Yeah.
So if you want to buy or sell a bond, it is, you've got to find someone who wants to buy that particular tranche at that particular moment. Very difficult. So by bringing LiquidNet into the mainstream bond trading network, they like to think, and I think they will succeed, that they will be able to get the involvement of all of these large and mid-sized fund management groups around the world. I think this process will greatly improve liquidity for some of these fund managers. And if you get extra liquidity, it's worth loads of money. So ultimately, we think it's going to get a very good payback. At the moment, they're still implementing it. They've got 2 or 3 of the largest brokers in the world coming on stream, which helps make market making. They want 2 or 3 more. But I think once it gets up to critical mass, my view is it will take off. So here's a business which is perceived as a fairly dull business. Share price hasn't gone anywhere for many years. It's producing a very nice yield, nearly 7%.
Yeah.
But where the cash payback, and particularly this opportunity with the new growth stream, will actually potentially not just drive sales, not just drive more profit, but ultimately drive dividend growth. And ultimately, that's why we've got it in the portfolio. So again, very overlooked. Lots of UK companies are, but more importantly, with that upside potential. Dividends are great, dividend growth is what we're really interested in.
And when you look at the valuation of DPIcap, do you look at it in terms of, is that some of the parts, or you look at it in its entirety? Because you've got this sort of new revenue stream effectively starting to come up, and I'm assuming over time there's going to be value ascribed to that, and potentially a very different part of the business. So again, we're exploring catalysts for change, etc. Is how do you look at the valuation for it?
Well, it's interesting in this case because they've got a core business, but they also have a data business actually, a bit like London Stock Exchange or whatever, collecting data. The value of that data business is, different analysts have different views. Could be worth 50% of the market cap, could be worth 70% of the market cap. We don't know. So it may be that they sell the data business, and so you get an enormous uplift on that. In terms of valuing it, we're not just interested in that. What we're really interested in is not just the £1 million, but how many millions of pounds they make. Being a financial, lots of fund managers are a bit uncomfortable. They don't really like financials, it's a bit complicated, so they stand at low valuations anyway. And particularly if you can get this growth story underneath, then as that cash flow comes through, as that dividends come through, ultimately we think the share price will be dragged up with the dividends. That's the key aspect here. So in valuation terms, it's the cash and cash generation which gets us excited.
Yeah. And we've talked about, customer service or an interesting product or something that makes a really big difference to the end customer. Management is clearly one of the things that when you're evaluating a company you get excited about, and I was looking at Concurrent Technologies, which I think you've got a holding in. Again, perhaps explain what it does, what excites you, because it feels like there's a new lease of life in this company.
Yes, I mean, in a way, the previous management team were very dedicated and they did a good job. But ultimately, it was very, very overlooked. It's in specialist ruggedizing electronics, particularly for the defence industry. So if you are in a trench somewhere, and you've got electronics with you, clearly, you jump in and out of the trench and all the rest of it, and they need to be very ruggedized. It's very sort of well integrated with the electronic manufacturers, electronic companies of the world. So things like Intel and stuff. It's very, very early to know about new Intel chips because they've got to get them into the board so they can sell them to the military. So going forward, ultimately, this is a business which has done well already. I always felt that one day we'd come in, we found that someone would pay 3 times the current share price for it in a bid. Actually, what's happened is the management team of the previous management CEO's retired, a new CEO's come in, and actually he's really invigorated it. He's not just got the foundations, he's got more opportunity to actually widen the range of products, slightly improve the customer service. I think it was good already, but I think he's slightly picked it up further. And ultimately, that's really changed the trajectory of the business, actually. And so we're now seeing sales growing considerably, actually. Clearly, defence spending is rising as well. So net effect of investment going forward, extra engagement with customers, extra range of products, and an industry which is expanding has meant that actually the share price has started running. Clearly, it's all about cash generation. At the moment, they're not paying much dividends. They're forecast to pay much dividends going forward. But we think as they get more sales, because it's such high margin product, that will actually fall straight down to the bottom. They will generate lots of cash, and we get lots of dividends in due course.
And is that, look, I mean, the things that we've talked about, which is an innovative product or a high quality element of service, etc., or a bit of the business that might sort of start growing quicker or realise value in different ways. That's or a management team that sort of changes the trajectory of the business. When we come back to the idea of optionality, or
absolutely,
that's what you're looking for, and ultimately it comes down to at some point the change is so big that you ought to see it in the valuation, and these are the things that will hopefully unlock the value in the small caps, which and start to see the performance coming back. Is that fair?
I think it is. I mean, ultimately, a friend of mine, a tech analyst from 2000, the dot-com era, it said to me very knowingly in the past, he said, we're all trend followers in the end, right? So what's happened is the trend's been following the US, it's been marvellous, and the mega caps have outperformed, and caps has been taken out of the UK, and it's been particularly taken out of small caps where there's no alternative buyers and stuff. So we're all trended followers, but ultimately, we've moved beyond globalisation. We've got the fragmentation of global relationships. We're in a period now where, geopolitical events are more out there. We may have more recessions because we can't stop inflation in the same way. So coming back to it, the pattern's changing. I think we're going to see people buying good and growing income as a mainstream. I think as that drives outperformance, then we see people taking money out of international markets such as the US and bringing it into the UK. The effect is going to be disproportionate at the smaller end. They've fallen to absurdly low levels in valuation, so you've got the catch up on them. But more importantly, the point you're raising, which is the optionality, means that yes, you might generate some good returns. I think the UK market will be one of the best performing for the next 20 years, actually. I'm tremendously upbeat about the cash compounding of income going forward. But I think the small cap sector will be one of the best performing parts of one of the best performing markets in the world. Now that's going to drive trend followers. not just into the UK, but into the small cap area, drive up valuations, and actually enhance the ability to make money because they've got a lower cost of capital. They can invest at a faster rate to generate even faster returns. So we're looking at a sort of a virtuous spiral, a virtual spiral building. I'm tremendously upbeat as it comes. Yeah, yes.
And look, I know that you're a champion for the quoted companies and the work you do through the QCA, and actually advocating change within HM Treasury and things like that.
Absolutely.
So if I was to, I guess coming back to the original part of the conversation, we need to see change. I feel like if you can get that spark that gets the momentum going, that trend starts to happen, right? So if I gave you the soapbox and said, look, if you were to say, look, what 3 things would you love to see changed, what would you say?
So the main thing is, I think we're at a hair trigger. So I think if nothing changes over 3 and 5 years, I think it all happens anyway, right?
Yeah.
So this is all just accelerating something which is probably going to happen anyway.
Yeah.
So I think in which case you need almost nothing. So rather than consult on the 5,000 into the ISA, ring-fenced ISA, I put all 25 into the UK ISA straight away for beginning this tax year. I probably would actually push on a bit as well. I think income. You can buy very good income on the UK market with the diverse income trust and others. So you could actually borrow 10 billion if you were Chancellor and put 10 billion into UK focused companies generating income. You would actually generate a profit because the income is greater than the cost of debt.
Yeah.
But much more importantly, you would actually bring forward the ability of the UK market to recover. And ultimately, if I was an MP, I'd be insisting that 50% was put in UK equities rather than 3% currently. Right?
Yeah, yeah.
So those are the kind of things I think we could do, which would just spark it. And once you get the spark going, trend followers all come in, just like Japan, it breaks out on the upside, and then we're just on our way. And local corporates can raise capital, invest, generate productivity improvement, which means we can pay wages, but more importantly, skilled employment, low extra taxation. I think it's just a wonderful moment.
Thank you, Gervais. Gervais, it's been a pleasure having you back on Vantage. Thank you very much, and we look forward to checking in on you later on in the year. Thank you very much for tuning in. If there's any other stocks you'd love to hear about, please do let me know. With that, Gervais, thanks once more.
Thank you very much.